I was joking a minute ago, never try to start something in New York City right on time, because it doesn't, and not on a Friday morning, just doesn't work. Anyway, welcome everyone. My name is Trish Mosser. I am the Director of Central Banking and Financial Policy at the School of International and Public Affairs. I'm very pleased to see everybody here. Franklin and I thank you all for coming. A little background about this conference. When we started putting it together, which was more than a year and a half ago, quite a while ago, it was on a lot more narrow topic than it is today. But what can one say? The forces shaping the financial sector that we're going to talk about today, technology, anti-globalization, populism, whatever title you'd like to give it, and certainly regulation. It seems to us their impacts have accelerated, and the changes are happening even more quickly than when we started to talk about it. And so every month we kept broadening the conference till finally we decided we're just going to go all in. So that's the background. A few things about logistics. Their Wi-Fi. Columbia University, no password. It's there. It's everywhere. Help yourself. Restrooms. Back through the elevator banks. Men's are on the left, women's are on the right. The conference is being videotaped, and there will be some press in and out during the day. After the conference, we do plan to post the videos of the sessions, and with the speakers' permissions, any presentations that they might have. We will send a link to that when the site is up and running. We have a pretty full day, as you can see, and we do want to leave time in every session for plenty of questions and answers and discussion across the room. So the session chairs are not going to give long intros to the speakers. We got everybody's name up here, and all of their detailed bios are available in the program. So again, there's one exception to that, and that is in the first panel. We have one panelist who's not on the program, John Authers from the Financial Times, who very kindly agreed to join us by the time we'd already sent things off to the printer. So welcome, John, and thank you in particular. Welcome to everyone else, and I hope you enjoy the day. Thanks. The first panel is on lessons from history. What can we learn from the historical experience of very large shifts in technology, politics, regulation, and how they've reshaped the financial system? We have four great speakers: Michael Bordo from Rutgers, Jeffrey Gordon from Columbia Law School, Harold James from Princeton, and John Authers from the FT. So we'll start off with Michael.
Well, thank you, Patricia. Thank you, Franklin, for inviting me. It's always nice to come here. Coming to a conference at Columbia means I don't have to take a plane. So it's always a treat. Before I start, I end this talk on a pretty optimistic note, but what's going on with NAFTA has got me a little worried. Okay, but anyway, the recent rise of populist anti-globalization political movements has led to concerns that the current wave of globalization might end in turmoil, like the first year of globalization, which ended after World War I. And I define globalization as the integration of markets for goods, labor, and financial capital. And that displayed a U-shaped pattern from 1870 to the present. It was high in the late 19th century and early 20th century, and then it dropped significantly after World War I, and then it recovered after World War II. And the first year of globalization ended because of a backlash by the losers of globalization in the US and Europe. And that led to an increase in tariff barriers, capital controls, restrictions on immigration, and also a lot of political instability. So many people say that the repeat backlash may be happening now, and what we see, as I'll show you in a few minutes, is a flattening in world trade and capital flows since the great financial crisis. And so what I'm going to argue is it's too soon to tell. I think that the drastic decline in trade and capital flows reflected the Great Recession. And since 2010, there's been a flattening of trade, but that reflects other deeper forces, a slowdown in the growth of China, the reversal of the extended supply chains that were developed since the 1990s, as well as increased financial regulation. So what I'm suggesting is that there's either a pause in the pace of integration or maybe a slowdown. So let me just quickly run through the story of this U-shaped pattern and the two eras of globalization. So the first era of globalization was preceded by major political and technological changes. The setting behind it, all of that, in my view, is the sort of, and I have sort of a Whig view of the world, is the Glorious Revolution of 1688 in England, which created property rights and the rule of law. And I think both of those were needed for the financial revolution which followed. England isn't the only, Britain isn't the only country. The Netherlands was a key player in that story. And that gives you the backdrop to the Industrial Revolution in England in the 18th and early 19th century. And then you've got political stability after the Napoleonic Wars with the Congress of Vienna, which creates the balance of power, and Pax Britannica. Again, these issues are I'm giving you very big overviews, and there's lots of controversy and subtleties about that. Same time, you get these key technological changes in the 19th century. The steamship, the telegraph, the transatlantic cable, that really transforms both trade and financial flows. I'm not going to talk about migration in this talk. I've done that in other papers. So just looking at trade, the opening up of trade began with the Age of Discovery in 1500, but the really rapid globalization doesn't occur until after 1815. And then exports grow by 3.5% versus real growth of 2.7%. In the 20th century, we again had a period of rapid growth. It wasn't quite as rapid. So I have a figure in here. This is figure 1 that sort of shows these different eras of trade, growth of trade relative to the growth of output. And the first period, the pre-1914 period, so the story was quite familiar, as the factors that opened it up were the big reductions in tariffs, especially following Britain's abolition of the Corn Laws in 1846 and the Cobden-Chevalier Treaty of 1860 between Great Britain and France, which created a whole network of most favored nations tariffs. And that process was partly reversed after 1879, and there was a backlash by landowners in Europe, and led to a rise in tariffs. Then, of course, we know that trade collapsed. You can see that in the panel B. That trade collapsed with World War I and the Great Depression in the face of rising tariffs and quotas. And then after World War II, the GATT comes along, and that sort of rolls back tariffs in successive rounds, and then we get a WTO, which reduces non-tariff barriers. So that by the 70s, the ratio of trade to GDP reaches the level of the early era of globalization. Okay. With respect to capital flows, the pace of international integration of financial capital followed a U-shaped pattern too, like it did with trade, and it was interrupted by the imposition of capital controls in the era of the wars, World Wars, the Great Depression, and then in the Bretton Woods system. So I've got a figure here, figure 2. This figure shows you the ratio of the current account balance to GDP for a group of both advanced and emerging countries going from 1870 to the present. And there are 4 episodes that are in this picture. There's the first is the 19th century pattern, 1870 to 1940. That was the period of the gold standard, fixed exchange rates, open capital accounts. So you get massive capital flows, and you get a convergence of interest rates. Okay, and then the second period is the bad period, 1914 to 1945, the war, First World War, Great Depression, World War II. That completely disrupts financial globalization. There are capital controls and exchange controls. And then after the war, okay, it's going to take me a little longer. After the war, we get to, we still have capital controls with Bretton Woods. So the story is explained by Obstfeld and Taylor, who talk about the U-shaped pattern. They explain that by Mundell's trilemma. So there was a backlash, and the era of globalization ended with World War I, and it was preceded by a backlash. And O'Rourke and Williamson document how globalization led to the convergence of real wages, real incomes between Western Europe and the periphery through factor and trade flows. This affected the distribution of income, and this led to the both a rise in tariffs and a reduction in globalization. And then the backlash to globalization fanned the flames of nationalism. Competition between the old and new industrial powers led to increased political tension, leading to World War I. And then the interwar, things get worse. The end of capital mobility, the shocks of the Great Depression culminate in 1931, which is really the breakdown of the beginning of the breakdown of the international order, which creates tensions, leading to World War II. And then things are improved after World War II, which sets with the United Nations, Bretton Woods, and GATT, and that gives you the backdrop to the second era of globalization. So it's been 50 years since the second year of globalization started. The question is, are similar forces at work? Are we on the brink of a massive deglobalization as occurred in the interwar? And so I look at both trade and I look at capital flows, and I show you that that in the great financial crisis, we did get a big drop in trade, okay, this big spike downwards, but then it bounces back, okay, but it doesn't start increasing. It just sort of flattens out, and much of the decline reflected cyclical forces, especially the collapse of investment in the Great Recession. Okay, but there are also these secular forces that are at work. There's the collapse of the global supply chains between the advanced countries and China, and that reflected, in some sense, diseconomies of scale, and the big multinationals are localizing. The second factor was the slowdown in the growth of China from over 9% per year to 6.5%, and China's big. It represents 15% of world output. And also, protection was not a big deal. I mean, it has increased since the global financial crisis, but it's not a key factor. And that's very different from the 30s, when the rise of tariff protection was the key determinant of the collapse of global trade. So globalization of trade is downshifted. So the question is this temporary or is it permanent? I do the same thing for capital flows. Okay, and I show you that you got this big drop that occurs. So this is net capital inflows. You get a big drop that occurs in the global financial crisis. Okay, and it doesn't come back, but this I think again reflects the recession. It also reflects regulation, and also as in the 30s. Banks were blamed for the global financial crisis. And you can see this in this figure 5, which is a picture from Kristen Forbes, which shows you a total drop in cross-border financial flows. That took a real dive in the crisis of 2008, and it's come back, but at a much lower level. And that reflects microprudential policies which targeted cross-border loans more than domestic loans. Okay, so put it together. Okay, going to take another couple of minutes. The global financial crisis was a huge shock. which stalled the pace of globalization and may be the beginning of a reset. There's been a populist backlash against globalization and technological change seen in recent elections. As in the first year of globalization, the losers have turned to political action. And there's evidence, again, this is well known, this work by O'Toole and others, that since joining the WTO, Chinese imports have displaced large numbers of workers in the US and Europe. And so the losers from globalization and technological change have been opponents of globalization. So the question is, will the current slowdown and possible reset of globalization mark the end of the second era of globalization? I argue it seems unlikely, and I have five answers, or reasons. One is the growth of trade is more widespread than it was before 1914, so the groups harmed are outweighed by those that benefit. I have Walmart here as just an example. There are more escape valves in trade legislation. Trade disputes can be resolved by the WTO. Many countries did adopt compensation packages and retraining schemes to help the losers. Most countries have learned to follow stable macro policies in very sharp contrast to the 1930s. The Fed learned the lesson from 1931 during the global financial crisis. And the sixth point is the global proliferation of large multinational enterprises is different than pre-1914. The cost of unraveling this seamless web of interconnections with tariffs and other restrictions would be disastrous. So the prediction for the future of globalization depends on the direction of the political forces at work, play in the world. So negative shocks like Trump and Brexit, they may reduce the growth of trade. Positive shocks like the French elections may reverse these forces. Increased financial regulation throws sand in the wheels of financial globalization. So the real question is whether these short-run, typo here, forces will change the dynamics of international capitalism. Millions have been lifted from poverty in the second era of globalization. Millions of others have improved their living standards. The losers from globalization are a vocal minority, but they're still a minority. So in my view, the bottom line is the second era of globalization is not ending. It's going through a reset following the great financial crisis and the inevitable political reaction to it. Thank you.
I come to this as a legal academic who's worked with economists, and so my approach is going to be look at some of the institutions of global finance, the institutional structure of them, as a way of trying to set sort of the framework for today's discussion. And I taught a course with an economist, Patrick Bolton, for a few years now, and we look at crises, plural, and reg reforms, plural. And so some of the ideas that have emerged from our years of discussions has history does not come to an end in this field. The one thing that is clear is that each set of reforms resets the financial system and creates the pathways for the crisis to come. The financial system is not a natural system, it's not physics or chemistry, it is rule-based. And each significant change in these rules will change the financial system, and in ways that are frequently quite unpredictable. Second point, financial stability is a public good, and it's costly to maintain. All of the restrictions on the bank balance sheet, the asset side, the liability side, the activity side, they're costly. And much financial innovation, in fact, arises out of the effort to evade those costs. The goal is to avoid the financial stability tax wherever you can. Let's not kid ourselves about what fintech is really about. And therefore, what we need is a strategy of dynamic precaution in order to maintain financial stability. And therefore, in thinking about the reforms that emerged out of Dodd-Frank, perhaps the most important are the ones that attempt to provide a way to focus attention on the financial system as it evolves. First, the Office of Financial Research and Treasury, which is responsible for just trying to get a sense of the financial system in its evolution. Second, the role of FSOC, the Financial Stability Oversight Council, to, in effect, expand the perimeter of systemically important financial institutions, or at least engage in a negotiation with firms that are on the verge of becoming systemic in the effort to dial them back so as to avoid the wholesale evasion of the financial stability tax that I referred to earlier. And then second, the stress tests run by the Federal Reserve, precisely because they look at the banks not on a bank-by-bank basis, but on a system-wide basis in ways that no bank itself can actually observe. And so, so history is the future, and I want to give two examples of how measures that were put in as reforms in their day, in fact, became the vehicle for financial crisis in the decades to come. So part of the claim here is that Glass-Steagall itself, not the repeal of Glass-Steagall, was the foundation for the crisis of 07-09. And the reason for that is because Glass-Steagall produced what we call the rise of market-based credit intermediation, namely financial firms that engaged in the transformations of liquidity and maturity that we know in the banking system give rise to patterns of instability. Under the Glass-Steagall, we had these non-bank financial firms engaging in these bank-like liquidity, maturity, transformation activities without the safeguard of prudential oversight, without public deposit insurance, without public LOR facilities, LOLR facilities that in the setup of banking we've come to think of as important for the stability of the banking system. So that's what Glass-Steagall did. And so what are the steps? So what Glass-Steagall did is to divide the world into commercial banks and investment banks. And investment banks, precisely because they could not make commercial loans, worked hard to use markets to create a replacement for commercial loan activity for firms. The investment banks quickly came to realize that selling stock, that issuing stock, firms don't do that very often. But they're always trying to raise debt or refinancing themselves. And so therefore the real money was in figuring out how to use securities markets to create credit facilities for non-financial firms. That's where the money was. And particularly in the US system, which for various laws we're not going to have time to go into today, created a fragmented banking system. Multiple small banks, state by state, hard to branch, very hard to go interstate. So the US had a fragmented banking system, which, when it came to financing these national firms, had challenges relative to the investment banks, because the investment banks, in a sense, could look to a national funding market when they issued bonds, whereas if you were a bank trying to lend money to GM in a large scale, you had to put together a whole group of other banks. And there were multiple coordination issues that would interfere with the low-cost way of providing substantial credit to national scale non-financial firms that the investment banks didn't suffer from. That's one point. Second, in parallel was the rise in the US of institutional sources of market-based finance. So the pension funds and other forms of the institutional investors didn't need banks for portfolio diversification and the ability to evaluate credit. They could do that themselves. And the investment firms, the investment banks, were able to make use of these new funding sources to, in effect, come up with a lower cost of funds than the bank themselves could provide, even putting aside the coordination issues. And then finally, again, sort of a wonky issue, the Bankruptcy Act of '78 made it easy, sort of narrowed the gap between the bank ability to restructure a failing loan as opposed to the investment banks. So, second, the investment banks began to pursue a spread business, much like banks. Their assets were long term. Their financing was short term. And short-term creditors like deposit insurance, right? So what the banks did is what the investment banks did is create the functional equivalent of it with repo finance, in which it's a form of secured loans. The investment bank can't pay you for clothes on collateral. We need a LOLR privately provided by the banking system. Well, the financial crisis showed that this freestanding investment banking model is not sustainable. Deposit insurance, for various reasons, the private deposit insurance failed. Gary Gorton's got a lot of discussion on that. The LOLRs failed. The banks were unable to provide the liquidity support that everyone was counting on. But let me just go back to Glass-Steagall in a more general way. So Glass-Steagall created silos. It changed the way folks thought, not only in the US, but Europe as well, because of the dominance of US thinking. Bank reg was prudence. Securities markets was disclosure. The banking agencies didn't appreciate the importance of markets and credit-based financial intermediation, and most importantly, the SEC, the securities markets overseer, did not think that its role was about prudential oversight. It was just really about disclosure and enforcement. So in effect, because of the silos, both in the agency sources and also the thinking, the intellectual gaps, this form of market-based credit intermediation created bank-like risk with nobody really noticing until it was too late. And the FINREG agencies, frankly, were more engaged in clientelism than they were in thinking about the new emerging risks from the integration of securities and banking. And indeed, you see the clientelist activity even after the financial crisis when it comes to the SEC effort to deal with money market funds. Let me just spend a minute on deposit insurance, which was a stabilizer in the Great Depression, and it became an agency of crisis expansion later on. So what's important to notice is that deposit insurance in the Great Depression was coupled with a cap on the rate that banks could offer to depositors. What this meant is that the banking system became inherently safe because the banks were able to win on a spread business. Your deposits were going to be at a fixed rate. You wouldn't need to compete with any other bank for deposits, at least via rate, and you could lend out for more than you were paying for deposit. That spread business, that's a franchise value. The shareholder's skin in the game was, in effect, the franchise value of the bank. That was sufficient. You didn't need to worry so much about the right-hand side of the balance sheet. And deposit insurance in that world protected against systemic risk, panic runs, exogenous shocks, but most important, it didn't provide particular incentives for extra risk-taking by banks. In other words, the moral hazard of deposit insurance as of the Great Depression was very low precisely because the style of banking that it created by constraining deposit limits was kind of inherently safe banking, where the risk-taking incentives were constrained. All right, so then what happens with exogenous shock? How does deposit insurance change? And this is what's so neat about this story, right? So in the 70s, the yo-yo shocks, inflation, money market fund rates go way up, and what we get is the money market funds, who are not constrained by Reg Q, who can offer depositors a much higher rate, and therefore, in effect, the banks are losing their funding. So what's the modernizing reform for the bank, which is to eliminate Reg Q? And guess what? That then, for the first time with deposit insurance in the United States, makes it a mechanism of very serious moral hazard, in which, in effect, you can compete for deposit flows. You therefore have incentives to reach for yield on your assets. And, you know, the short story is this massive moral hazard led to the S&L crisis, $350 billion. And the point I want to make here is that we have reforms. In one setting, they provide stability. In another setting, with relatively what seemed to be minor rule change, an agent of financial destruction. So we come back to this point, which is that financial stability is a public good. It costs to maintain it. And there's always innovation because of the effort to avoid paying the financial stability tax. And therefore, the most important strategy, I think, is one of dynamic precaution. Cost-benefit analysis simply does not help very much, because cost-benefit analysis is based on generating costs and benefits of the system before you make the rule change. But any significant rule change is going to transform the financial system in ways that will dramatically change the setup of costs and benefits. And therefore, a much more important strategy in this area is what I'm pushing, dynamic precaution, rather than the idea that you can capture financial stability in a bottle and it'll be good for all times.
The previous two contributions and think about what we can learn from some historical episodes. In particular, when we look at a big financial crisis, there's clearly afterwards a demand for a new kind of regulation. And the regulation, I think, can push in two different directions. And some of the question of designing regulation after a financial crisis is exactly the trade-off between these two areas. So you can try to make the system much more resilient, more elastic. In the early 20th century, everything was discussed in terms of creating more elasticity. Or you can try to make the system more secure, and you can try to limit volatility. Looking back on the episodes that I want to think about, they're both characterized by really big technical changes, not just in technology as a whole, but also in the technology of the financial service industry. And they're also characterized by a big interconnectedness, a globalization. And I want to look in particular at two moments of deglobalization to think about what we can learn about the question that Mike Bordeaux started off with. Is 2008, the legacy of 2008, going to produce another kind of deglobalization? And so I want to look at the crisis of 1907 and the Great Depression, then 1929 or 1931, the big financial panics, the New York Stock Exchange, but also in 1931 the Central European credit crisis that then exploded all over the world. What both those events are to do with is international connectivity. So when we try to explain them, it's not easy. Like 2008, they're very, very complex events, like explaining a plane crash. There are all kinds of things that go into it. But one very clear element in 1907 is the large movement that was taking place. In April 1906, there was a big earthquake in San Francisco, and a debate then about how the insurance is handled. In the second half of 1906, very, very big payments from London insurers to the United States involving big gold movements. And then the Bank of England responds to that by putting up the bank rate. That then leads to a stringency in New York, but also in other financial centers in Japan, in Germany, in Egypt, in India, and a global transmission of the financial crisis. So 1907 wasn't just an American crisis, October 1907, the panic in New York, but it was a general crisis. And it raises a question of design. People looked at Britain, which in some ways was at the center of the financial world and where the decisions in the Bank of England were driving the financial crisis, the bank rate increase. But Britain wasn't at all hit by the 1907 crisis. And so in other countries, in the United States or in Germany, there's the thought that you need to imitate the British mechanisms that provided for a more elastic currency. And so in the United States and in Germany, elsewhere, a rethinking of the financial structure takes place. But it's done primarily with the idea of safeguarding the national economy and the national financial system against flows from elsewhere. The figure who played a really key role in designing the new American system, Paul Warburg, played such a role because at the beginning of 1907, before the crisis, he'd written a long article in the New York Times which warned about the dangers that the undeveloped financial system of the United States posed to the US economy. And so he appeared as a kind of Cassandra who was right. Becomes very influential. It's interesting, I think, to look at the language which Warburg uses in this discussion, because the word that he calls on again and again, and that enters then obviously into the institution that's the end result of this, is he says we've got to think of reserves, and it obviously becomes the Federal Reserve. So unlike the Bank of England or the Bank of France or the Imperial Bank in Germany or the Banca d'Italia, it's not the Bank of the United States, it's the Reserve Bank. And Warburg says explicitly that he thinks of reserves as the equivalent of military reserves. So an army needs reserves, and you need a defense mechanism. So the thinking is in terms of security there, of doing something that will limit the impact of cross-border flows. Oddly enough, exactly the same discussion occurs in Germany, but pushed by the older brother of Paul Warburg, Max Warburg, I guess you call him in the German context, who was the financial advisor of Kaiser Wilhelm, comes from a famous banking family in Hamburg, also with a kind of defense in mind. So here the story is that a financial crisis pushes thinking in national terms, not just from nationalists and populists, but from regulators as well. And another key part of this is that it's to do with thinking in broad security terms. So this is a period in which there's an increasing arms race, and the financial crisis in 1907 contributes to the deterioration of international relations, because there's a widespread awareness that financial panics can be used as an instrument to destabilize other countries. In the Moroccan crisis in 1906, again in another Moroccan crisis in 1911, that's exactly the logic, that powers try to use financial crises to push other countries around. There was a suspicion in Germany and the United States that the United Kingdom used its powerful financial system, the merchant banks that finance trade all over the world, the global insurance system in Lloyd's, in order to extract sensitive information that allowed the conduct of a military blockade. So finance becomes securitized in the aftermath of a financial crisis. It's a very, very similar story in the Great Depression, where again, major capital flows and panics, cross-border effects play a critical role in the transmission of the crisis, particularly in the second phase of the crisis after 1931, that really makes this the Great Depression. Again, countries are using financial panics for security purposes, to try to force changes on other countries. Because if you're faced with a financial panic, it creates often a fiscal problem. You need fiscal adjustment, and the way to do that, the obvious way in the interwar period, the major source of fiscal expenditure was on the military, and so you cut back the military as a result of a financial panic. So what financial panics do is to promote suspicious minds. You know, I like the Elvis Presley concept of responding to a financial crisis. Suspicious minds. We can't build our dreams on suspicious minds. And defensive mechanisms. And so I think you see exactly this, that the aftermath of 2008 has been that in China, in Europe, you need to develop alternative mechanisms. You don't want to be connected or dependent anymore just on the global system, but you want to go for a national or sometimes a regional form of security. And that lesson was actually very, very clearly learnt in the course of the debates in the 1930s and in the Second World War about how to fix the system, how to redesign it. And one of the critical visions in 1944 at Bretton Woods, in 1945 when the United Nations was set up, was that security and financial regulation are interdependent with each other, and that they can't really be separated. The 5 largest members of the World Bank and the IMF in the original formulation were also, with a single seat representatives on the board, were also the 5 permanent members of the UN Security Council. So it was the United States, the Soviet Union, the United Kingdom, France, and China. But for a kind of historical freak, because the Soviet Union never ratified the Bretton Woods Agreement, and the revolution took place in China, the UN and the Bretton Woods institutions diverge on this. But the critical vision that security and international financial stability are linked was very much drawn out of the lessons of the Great Depression. It could have been drawn out of 1907 as well. And I think it's a lesson that we still need to think of, and raising a critical question: how are these new regional security mechanisms, the Chiang Mai Initiative or European Stability Mechanism morphing into a European Monetary Fund, going to be connected with the international architecture in the future? And thank you.
Good morning, everyone. It's always a great pleasure to speak at Columbia. It's my alma mater. I actually spent a year living virtually next door at Butler Hall on 119th Street and had more or less this view, although not quite as expensive as this. So it is always a privilege to do this. I have to admit it does at times seem like a slightly dubious privilege, given that, yes, I discovered I would be making this talk at about 2:30 yesterday afternoon, and then discovered at about 6 that I wasn't, as I had been told, being the moderator of this discussion. I was actually being asked to do a presentation. Now, I haven't written a nice big 10 or 15 minute presentation on financial history since I left the office last night. I'm sorry. So, what I can, however, try to offer, I write the long view for the Financial Times. I've been doing that for more than a decade now. The prime idea, as you might guess from the title, is to try to understand the lessons of history and apply them. And also, just in the last few days, I have had no alternative but to focus on some specific aspects of financial history. So I'm going to talk briefly about what the lessons of that particular juncture are, and then I will also make a few comments on the presentations we've heard so far, which have the huge merit of taking subjects I already have quite strong opinions on and suggesting I'm wrong about them. So I will give my brief tentative responses to those, which I hope will forward a dialogue. Now, yesterday did give us the crux for two very interesting moments of history. One is that, like every other financial journalist in this country, I was obliged to write reams and reams and reams of material about the 30th anniversary of the Black Monday crash. In many ways, it turns out that Ronald Reagan, who appeared to be totally out of touch when he described it as a correction at the time, was, of course, right. It was a correction. The market was made back its gains in little more than a year, but it still was a moment that showed that the efficient markets hypothesis, the random walk theory, really needed some work on it. It wasn't as though there was new information that caused people to think that the US stock market was worth 20% less at the end of the day than it was at the beginning, and it suggested that there was something wrong with the institutional structure of the way capital was allocated. Now, some of the lessons that do seem to ring clear from Black Monday, from the attempt to deal with it, are, and this comes back to the notion of regulation, a critical problem then was the inadequacy of the regulation, which wasn't designed to fit the activity that was going on. You had a mismatch between the trading of stocks, which was taking place largely here, and the trading of futures based on those stocks, which was taking place largely in Chicago. At that point, no longer the case now, exchanges were effectively monopolies conducted on a physical basis by human beings with the aid of computers, rather than as now basically conducted by computers with the occasional aid of human beings. Now, the problem, one of many problems, was plainly you need many, many transactions, many trades, regard a combined buying or selling of the stock and of a future based on that stock or a stock index as one organic whole. They are part of strategies. I spend my life talking to people about how they have built their strategies, built their portfolios around this, but stocks are regulated by the SEC and futures by the CFTC, which was designed largely to regulate the Chicago-based business of helping farmers guard against various risks for their harvests in the future. This basically meant that the regulation was totally unfit for purpose when you had a system whereby futures were being sold on one market in a fashion that more or less forced selling in the stock exchange, and that you then created a cycle. There was no one regulator who was in any position to deal with it. That's a rather serious issue, very clear-cut problem, and of course, today the SEC still regulates cash equities, and the CFTC still regulates futures and options derived from those cash securities. This one rather alarming example of a failure to learn from history. Further than that, though, there is an issue that I think is important, that sometimes there are limits to the value of history. If you take a look at how much the structure of markets, the way that capital allocation is carried out, has moved over the intervening 30 years, there is no longer a stock exchange monopoly. We more or less no longer expect exchanges to act as self-regulators. There is therefore no real means of knowing where trades are happening. This was a very well-intentioned, very sensible in many ways attempt to deal with the negative consequences of a monopoly, to make it possible to pay much less for trading. It's led to a proliferation of venues, which means very great risk of confusion about prices, about where exactly the market has reached. And it's also led to a proliferation of trading, which may or may not be a good idea. I think, therefore, the idea, I think the phrase is of dynamic regulation or dynamic re-regulation. I'm sorry, I didn't get...
Dynamic precaution.
Dynamic precaution makes very great sense, but you also need to look at a very much broader prudential system for that regulator to make that possible. If you have two regulators for what is essentially the same business, one and the same business, one and the same action, one and the same decision, when you move between the spot market and the derivative market based on it, it's not going to work. You cannot have that kind of dynamic precaution when you don't have an overarching view of it. Now, to talk more broadly, the other aspect of history that I had to deal with yesterday, I've been reading John Maynard Keynes by Hyman Minsky over the last 24 hours, thanks to the outgoing head of the People's Bank of China, who warned yesterday that he was concerned that China might face a Minsky moment, which I have argued is the more or less perfect central banking equivalent of shouting fire in a crowded theatre. It's an extraordinary thing. For those who don't know, a Minsky moment, which doesn't actually come from the economist Minsky himself, it's been a phrase that's come along since, is the idea that you have a build-up of speculation, you have a build-up of leverage, which reaches a point where it gets to Ponzi extremes, and then the coyote looks down, realizes he's standing on thin air, people suddenly realize this has gone too far, and you have a crash. It's obviously a model that fits what happened in 07-08 very, very nicely indeed. And you would think it was one of those things that a central banker could... You want central bankers to discuss this a lot in private, and you really don't want them to air any worries about these things in public. It's a very major step to take that. I've been trying to explain this, but also to add some context to it by actually reading what Minsky said. And it's fascinating. This book here, which I think is the main centre of what he was trying to produce, came out, he published in 75, written, as far as I can tell, in 72 or 73, at a point when what you might call the Bretton Woods or Marshall Plan model of capitalism has, thanks most obviously to Nixon moving the dollar from the gold peg, has run its course. things are looking very bad indeed in terms of stagflation. Everybody is looking around for a new model. Hyman Minsky's idea essentially is that, and it's an exciting idea that becomes very much more intriguing to many people after the experience of 2007, 2008, is that finance is inherently unstable and that therefore capitalism is inherently unstable, that periods of stability such as what you might call the quiet period, I think Gary Gorton's phrase is the quiet period, when you had state banking and Glass-Steagall, will, because they make people so calm, so confident that things will carry on, they beget overconfidence and lead to eventually over-speculation, over-leverage, and a Minsky moment. His version, and this is one part of it that I didn't realize, his version was to argue that therefore it was necessary to socialize banks and investment. That his argument was that nationalizing the towering heights of the economy was necessary to have vibrant capitalism, to have a vibrant private sector beyond. It's a debate that seems ancient now, but it seemed to make a lot of sense in the 70s. Thatcher-Reagan capitalism won out at that point. I think the fact that Minsky's ideas, or the whole notion of a Minsky moment, is now back in favor, I would suggest that we might come to think of a Minsky moment as being the moment when people seriously begin to think about that kind of a radical alternative to capitalism itself. Some brief further comments just to try to react to the what we've already heard in the 2 minutes that remain. I have sitting where I have been sitting and hearing quite the screams of anger and rage, and speaking as a British person living in America and seeing the result of a referendum and election last year, have tended to be much more pessimistic than Mr. Bordeaux about the chances that the losers from globalization will be seen to be a minority, and that we will continue with a form of globalization. I certainly hope you're right. The way that argument was made is a very, very positive one. I still am very worried about the centripetal forces that we see moving against globalization, and I'm certainly the notion that NAFTA might not be a good idea, that's kind of a keystone for the whole notion of free trade, that the US would depart from it, could be a very serious step in providing a flag for everybody else to decide that they can retreat in their borders. It's not something I advocate for a second. It is something I fear more than perhaps I feared more just before I heard those comments, but I'm still very worried about it. On the issue of financial regulation, my take, which is a much more consensus one, I fear, on the whole notion of Glass-Steagall, is that after the Great Depression there was a sense, and after 1907 there was a sense that the US could no longer put up with the idea that a bank run, or indeed a Minsky moment if we want to call that, would be our ultimate regulator of excess in the banking system, that we were prepared to put up with paying for some deposit insurance and prepared to put up with a less dynamic financial system in response for not having a panic every 10 or 15 years. And I think, in the post-bellum period, when JP Morgan is that era of the Gilded Age, when America is rising very much as China is rising now, there was a panic every 10 to 15 years, as I recall. There was that attempt to put finance back into a box did lead to what you could call the Bretton Woods Marshall Plan era, or that Gary Gorton calls the quiet period, which is the very big outlier in US financial history when there weren't a lot of bank runs. Bank runs do seem to have been a particularly American issue. I suppose you could argue that it was the attempt to create a balkanization between investment banks and commercial banks that spurred all the attempts to come up with new systems that were outside the regulatory basket for banks. Certainly, the decline of the banker and the banker's replacement as the person that made the decisions about allocation of capital with capital markets was an extremely important phenomenon that gathered force, particularly with commercial paper markets and money market funds and securitized mortgages in the 70s and 80s onwards. That said, you did see attempts to do that kind of finance before 1929, and you see exactly the same trends in Europe, where the whole idea was that they liked universal banks, they liked bank assurance, they liked national champions, and you see essentially the same pathology as you saw in the States. Come the crisis, US banking assets are roughly 100% of GDP. Germany, France, the UK is appalling, it's something like 400%, but we do have London as a financial centre as some kind of an excuse. Germany, France, Spain, you're talking 300, 400, 500%. So I inherently find it difficult to, I can see many problems with Glass-Steagall, but that account of how the financial system went wrong, I am initially inclined to disagree with. And I've got a signal to stop. My Minsky moment, or whatever you want to call it, has arrived. Thank you.
So thank you, all of you. I'll take moderator's prerogative. I want to ask one question, and I'm not even sure who this is for, actually, but I was taken by a couple things that I think all four of you alluded to, and that was the inward focus after a financial crisis or a panic, whether you're talking about regulations or institutions, the link to security, which I thought that Harold mentioned, I think is really interesting. But you do not get complete deglobalization. The pictures that Michael showed of really this huge U shape in the entire international interconnections going away for long periods of time. That doesn't happen after every one, even though that you do have these instances of more inward focus. Is there something, a trigger? Is it sheer size? Is there a reason why certain types of financial panics and significant changes in regulation, like 1907, 1908, that changed a huge number of things, particularly in the U.S., but really didn't lead to a truly global retrenchment of economic activity, whereas other episodes have done that? And is there something that differentiates those? And like I said, I have no idea who that question is for. But I'd like to know sort of if there are particular characteristics that seem to make the situation much, much more severe, so much so that the popular outcry is so large that you get almost complete isolationism as opposed to just a slowdown in trade. I'm trying to sort of get at one of the points Michael mentioned at the very beginning about, is this a temporary pause or is it the beginning of something worse?
I could say something about that. So my view on this is, in work, other work I'm doing right now, is there were two perfect storms. If we look at the last 100 and some years, the two really perfect storms were 1929 to 33 and the global financial crisis. So I don't put 1907 as up there in the same ranking. And a lot of things came together. Okay, it's not just there was a stock market crash, an asset price boom bust, a banking panic. There were a whole lot of things happening at the same time, including the kind of political forces that Harold talks about that led to these events becoming, climacterics, events that led to really permanent changes. And when you look at all the other financial crises, and I've done that, okay, going all the way back to the middle of the 19th century, they didn't do that, okay. 1907, yes, it was the culmination of a series of problems in the national banking system. And 1907 was the straw that broke the camel's back that led to reform in the U.S. Okay, but in terms of the world, it's these two events, and I would be very careful about making assumptions that because you get one of these perfect storms, that the retrenchment solution is the way to go. And Jeffrey's comments I thought were great. They exactly echo my views, which is, what did we get out of the 1930s? Okay, we blamed it on the banks. We blamed it on the central banks. We got financial repression, okay, which Gary Gorton calls the quiet period. Okay, that led to all of these other forces, okay, financial innovation, arbitrage, all these things, coming up with ways to undermine it.
Yeah.
And I agree with him 100% that that's the reason why we had that other crisis 80 years from now. So if we do this, I'll just finish this thing. If we go that way today, which we are going that way to a certain extent, okay, we may head off a few financial crises in the near future. Okay, things we're doing like Dodd-Frank and Basel III. But what we may be doing is creating another age of financial repression, which may lead to a much bigger crisis down the road.
So I think it's a very interesting question. And yes, it's absolutely right that the 1907 episode doesn't immediately lead to a deglobalization. So it produces a really severe recession in the United States and in some other countries, Italy, Egypt. But it's not producing deglobalization, but what it does is it produces this security thinking, and so it did seem to me. I mean, you know, maybe I'm reacting too much to current events and to 2014 and Crimea and the nuclear threat in Korea, but I think the system that you've got in the aftermath of a financial crisis does push in this direction of security thinking. And you know, the interwar period is full of that kind of example. So my favorite example for it is in Italy, where as long as the capital market is working, Mussolini looks as if he's behaving in accordance with all the rules of the international system, and he's quite well behaved. And then the moment that he can't get the access to the capital, he becomes nationalist and invades countries. So you can really see with the same regime that the aftermath of a financial crisis pushes you into security zero-sum thinking. And Gideon Rachman has this nice book on the zero-sum view of the world, and it's exactly what I think happens in the aftermath of a crisis, that if something benefits one country, it must be to the disadvantage of another country, and you spill that over into the financial system.
I guess one thought that occurs to me are there differences between now and the Great Depression, which perhaps suggests a less extreme reaction. And one of them is there's the EU. So if you were to track cross-border, i.e. global trade until the EU was formed, then all the cross-border activity between France and Italy would have been in the global bucket. Well, today that's in effect the domestic bucket, because the EU is this huge geographic trading area, which all of a sudden has recategorized a lot of trade from, again, the global to the domestic. And that's obviously a very positive thing for the long-term duration of quote, the global. Secondly, the economic shock of the Great Depression was just much more severe than the global financial crisis in most places, except ironically the UK. So some of my UK friends said that actually the impact in the UK, the contraction of the economy and the banking system, was in the 07-08 period even greater there than it was in the Great Depression, and maybe that accounts for Brexit, because just the extent of the severity. After all, the UK government still owns a large part of the banking system, which is kind of extraordinary 9 years after the events. And in the U.S., the shock was awful, but unemployment was at the 10% level, not the 25% level. And the availability of the stabilizers, they actually work to a significant extent. There's, the odd events of the November 2016 election, and it's not to say that irrevocable actions can't be taken, and NAFTA is perhaps one of them, but there's also a way in which some of the core features of economic integration haven't quite suffered the enormous shock that I think occurred in the Great Depression, and so maybe I'm a bit on the optimistic side, as Michael is, about where we would, if we were to have this event in 6 years or in 4 years, where do we think things had come out?
Thinking out loud, which I've been doing already this morning, that obviously if there's an impact on on the banking system, if you get the moment when banks actually go down, that makes a very big difference to the scale of the impact. In general, when people suffer leveraged losses, as is what happens if in the event of declines in housing markets, that also takes things to a different level. I suppose in terms of how great the international impact would be, why some radiate more than others, certainly in the case of the GFC, or whatever we want to call it, in 07 or 08, one of the most recent books on this actually refers to it as the North Atlantic financial crisis, because it really was rooted just as much in the European banking system as it was in the American banking system. And everybody in Wall Street knew that the mugs on the other side of the trade were German Landesbanken and these horrible, inefficient, bloated universal banks that had every incentive to look for higher yield somewhere else, and would find it on the European periphery where the yields were a bit higher and the quality was a bit lower, and in American subprime. So there were reasons from that why that crisis became more international than it had previously been, because of the extent of the internationalization of the financing beforehand. You could also make some arguments that the vogue for investing in emerging markets and in the commodities space, which had helped push up commodity prices and then led to great pain for a lot of countries that were particularly dependent on commodity prices, was something you could see something of in the 30s, but you wouldn't have seen in various of the other alarums in the period in the 20th century until you get to 07, 08. I think briefly talking about Britain, remember we also actually had a true, honest-to-God bank run, which people still think of as the crisis. Northern Rock and the photos of people queuing around the block to take their money out of a bank, which is still more famous than Lehman Brothers in Britain, and it really surprises people when I tell them that I think of the crisis having started somewhere else than in Newcastle upon Tyne, which is where Northern Rock is, Northern Rock is based. That I think did have a greater effect on the psyche. Similarly, if you look at the European periphery, one tends to think of that as an issue with the straitjacket of the Eurozone, with the flaws in the design of the Eurozone, which of course it is, but it's also an artifact of the reason Spain's property market went to the moon and collapsed, leading to 20% plus unemployment and 50% youth unemployment, is very similar to the reasons why various property markets went ballistic in this country and then crashed, and why we had the serious problems with unemployment here. It's basically the same thing, and the very significant problems of the Eurozone obscured that, can help to obscure that it's ultimately founded in the same problem.
Thank you. Questions from the floor? Paul was first, I think. We have a mic. If you wouldn't mind saying your name.
Okay, Paul Tucker, Chair of the Systemic Risk Council and Harvard Kennedy School. A question for the historians and a question for Jeffrey and John. The question for the historians, or for all of you, is most of the really big crises that you discuss, eloquently, if I may say so, occurred under a completely different type of international monetary regime. This is the first really big one in the post-Bretton Woods world of floating exchange rates. And I suppose my question is, big picture, do you think that the shift to a new type of monetary regime doesn't make a bit of difference to both the probability of crises and how they play out? Alternatively, does it make a difference, and what should we learn about the reconstruction of the world? My question for Jeffrey and John is that both of you, and to some degree Michael and Harold as well, but both of you talked a lot about capital markets and problems in capital markets and the role they played. And actually Michael did touch on this. And a striking thing, particularly about the United States, is that the SEC in particular, and to a slightly lesser extent the CFTC, would, I think, not recognize themselves as financial stability authorities. And so much so, I think, that it's kind of it's doctrine or a norm in this country that financial stability isn't really for market regulators. And that's actually not the norm. I mean, Hong Kong, which had the worst of the 87 crisis, it's the Securities and Futures Commission there very much sees itself as having a stability mandate because it was framed in the light of the crisis, and also because I partly wrote the report that led to its redesign. And in Europe, ESMA, which was born out of the latest crisis, when Jacques Larosière produced his report, it and Stephen Mayol definitely think of themselves. Stephen and Verena will definitely turn up at financial stability conferences and see part of their mandate about that. And my question to you is this is the biggest capital market in the world. Does it matter that the SEC and to a lesser extent the CFTC don't recognize this as part of their role? And if it does matter, what on earth should be done about it? Thank you.
Go ahead. Okay. So the question he posed for Harold and me is, does the exchange rate regime make a difference for the incidence of financial crisis? And the answer, it does. And the key thing about the regime we had until the 1970s was it was a fixed exchange rate regime based on gold. And that meant that you would get a lot of speculative attacks. So you had a very high incidence of currency crises. And if you have a currency crisis, you can often have that associated with a banking crisis. So twin crises are really bad, okay, in terms of output losses. And so that problem, the twin crisis problem, kind of went away with floating exchange rates. So that is one key difference. And also is that because you have the fixed exchange rate, you have a banking crisis in one country, it could be transmitted, through capital flows and through the current account to another country. You had contagion, which came through the exchange rate. So in theory, that should have ended in 1973, but it didn't. So then that whole other question comes about is, how much insulation do you get from a floating exchange rate? And there's this whole debate between Helene Ray and everybody else about the dilemma, is there a trilemma or a dilemma? And so it's not 100% clear why insulation didn't work. And it may have a lot to do with the fact that the problems that affected both Europe and the U.S. in the banking system they were both similar kinds of problems. So it wasn't just a transmission of a U.S. shock to Europe, but it was the fact that they all had the same shock.
I mean, I think there is actually a lot of evidence of spillovers increasing. And in that sense, the hope that I think was originally there, and the theory that you can decouple yourself by having a flexible exchange rate, it doesn't seem to work in the sense that you really see empirically the way that a move in U.S. interest rates affects Europe or vice versa.
I mean, in response to Paul's question, which is an extremely good one about who exactly is charged with financial stability and who is charged with ensuring that the financial stability tax, which is a good way to look at it, stays as low as possible. It's a seriously good question, isn't it? I mean, the Fed, as I understand it, is ultimately supposed to be in charge of looking at overseeing the risks in the securities markets and derivatives markets, but has no control over either, which is a very difficult system. The danger, as always, as we've recounted, is you cannot change regulation, you cannot change the rules, given that this is a rules-based system, without having at least some consequences that you haven't intended before. I think, the fact that the CFTC and the SEC continue to be separate entities, I consider indefensible. It would still, plainly something would go wrong as a result of the merger, so that the people who've been defending the division between the two would say they were right all along. But it still ultimately is not a defensible division of labour. I'm not sure that it's a great idea for the Fed. At the moment, you have a problem that vitiates the Fed, that it is a banking regulator, not per se a regulator of asset markets, but so many functions of banks have now been taken over by capital markets that plainly it does have to worry to some extent about asset prices, and that gives us the whole issue at the moment about whether part of a reason for tightening might be to rein in asset prices. The whole dilemma Greenspan had in the irrational exuberance era 20 years ago. It's the lack of clarity over who needs to consider this issue is a problem for all concerned. But the only idea I have, I can sure there are lots of problems that would emerge as soon as it came in, which is that you need some kind of an overarching regulator over the lot. I mean, I used to work with Ed Balls, who came up with a fantastic, great idea for reorganising regulation in Britain, and 10 years later, people came up with a few problems with what he had. Yes, that's true.
Yeah.
But I am not imaginative enough to come up with anything other than a major moving around of the financial regulatory deck chairs. Plainly, the current system really does seem to be silly, but there will always be a risk when you move those deck chairs. I cannot deny that.
So, couple thoughts. First, I think we were better off for not having the system of fixed exchange. Basically, the world ran on dollar deposits, and that put the Federal Reserve in the position of being able to be the lender of last resort to the world. And so, as you well know, their credit lines were, $800 billion at least in the crisis. No gold, and that permitted them, in fact, to address a lot of the potential instabilities in Europe, for example, and other places. And so you might say, well, then you're depending a lot on the benign good judgment of the Federal Reserve in deciding to extend swap lines at that level and in a low visibility way, so it doesn't raise the political concerns. But so I think actually the absence of fixed exchange rate, the absence of the gold standard gave the Fed tremendous flexibility, which it was able to use in a wise way to moderate many of the issues that might otherwise have arisen. On the question about the SEC is financial stability, I mean, that's obviously tremendously correct. And here seems to me to be the importance of the role of FSOC and potentially the capacity of the SEC to learn, and maybe a new SEC chair to take advantage of a vacuum in the following way. So it's FSOC's role, in effect, to point out emerging instabilities in securities markets, for example. And they did this in the case of money market funds, and the SEC, which was not inclined to act because of clientelist pressure, in fact did act and created a much more stable regime in money market funds because of in effect, floating NAV in the case of wholesale prime funds. And the SEC, when it comes to bond funds, has been much more concerned about liquidity of those funds, that is to say, the ability of them to fulfill their redemption promise without resulting in fire sale assets to raise cash. But I've kind of pushed the view that one thing the new SEC administration could do, particularly since the FSOC is plainly going to be in eclipse in the new administration, right? Is that one thing an entrepreneurial SEC chair could do is, in effect, claim the mantle of financial stability is part of what it is he does and the imprint that he leaves on the SEC, because there is a vacuum. You're exactly right.
They just published their priorities and are silent. They did not do exactly what you just
Well, there may be a new commissioner who will sort of push him in that direction, and, you know, a chair who has not a clue what he's doing, but all of a sudden has the chance to become kind of historically important in the evolution of the SEC, could perhaps make use of these authorities, and who knows. But you're exactly right to say that they've got a key role, and they haven't, at the moment, the evidence of a clue that they have it. And the crisis was filled with examples in which they failed to appreciate that role. So, there we are.
So I think Wilson was next.
Thank you. Wilson Irvin from Credit Suisse. I was curious about one of Michael's later charts that showed a persistent drop after 2008 in cross-border financial claims. And that was extraordinary to me because almost every other trend line you see has a bounce in it around 2009, 2010. And this one keeps going down, so the crisis pushes it down, and then it keeps going. Can you give us I don't know what goes into that, some color behind what's in there? And secondly, is this something that worries you? I like your optimistic take on things, but is this something that worries you and has any historical parallels that we should be concerned about?
Okay, so as I understand it, this comes from the BIS, and they've been tracking cross-border banking flows for a long time. And the story that Kristen Forbes tells and the BIS tells is that first of all, the crisis, sort of hits the banks, and that's how, that's sort of the epicenter of the shock. But then you get regulation, and regulation, they argue, that especially in the U.S., Dodd-Frank kind of discriminates against foreign banks, banks that are international banks, and puts more pressure on them and raises the regulatory requirements on them. And that's also coming out of Basel III. And so, in a sense, what it seems to be happening is there is this disintermediation in international banking as a consequence of the crisis, which, well, obviously is going to have serious ramifications. It also could mean that, okay, the banks don't do it, the international intermediation. Getting back to Jeffrey's point, somebody else will do it. If there's a demand for it, it'll happen. But that's what I think is going on.
I have
Harold knows.
I have a slightly different take on that, in that a large part of that is driven by renationalization in Europe. Before the crisis, European banking groups behaved as if they were single entities, and they moved a lot of money across in Europe. And then after the crisis, they focus, and the regulators push them to focus so that they're not really allowed anymore to do what they had been doing up to 2008. So it's specifically really very, very heavily driven by Europe in that story.
Both of those regulatorily make sense to me, and I think there's good micro evidence that I see from my world. But is this mostly a banking statistic, this particular chart?
Yeah.
Okay. And if you then rolled that forward, is that something that troubles you for implications historically, or is that something that you just say this is its own artifact, it's not that impactful for the bigger picture?
I'm not that worried about it. I think, as I said, I think there'll be substitution. But where the evidence comes from, and again, I'm referring to Kristen Forbes, she looks at the UK and shows how when they changed the regulation after the crisis, there really was a big shift, sort of that the capital ratios for banks that were doing international transactions were increased significantly from those that weren't, and that did have a big effect on their cross-border lending. So, and then she inferred from that this would happen elsewhere.
So, Sarah? Yes, she's coming here.
Actually, I had the same comment that Paul Tucker made. But a follow-up to that question on monetary regimes. It was said here that the fact that there was the EU facilitated or somehow buffer the impact of the crisis. I was wondering whether the euro make it difficult or not, and whether it facilitated also to deal with, say, the Fed. What could have been done in order to allow the countries within the euro system to accommodate better?
Harold, why don't you?
No, I mean the euro is clearly also part of this big issue, but I mean it's clearly got lots and lots of flaws, and we could spend a whole day analyzing them. But some of the story that is being told here, the big story, is not really a specifically euro-linked crisis, and that it's a sudden stop of capital that affected southern Europe, affected the members of the Eurozone, Greece and Portugal and Spain and Italy, but also affected non-Eurozone EU members, Romania and Bulgaria, or non-EU countries altogether. So there was a big capital inflow into Serbia and then a sudden stop. It does seem to me that it's more of a sudden stop story. But what the euro does is to make the adjustment to that actually more painful and make it more stretched out. And so the Bulgarian, Romania and Serbia story is actually a better one of bouncing back more quickly, whereas the Greece and Portugal one is not.
I think it might be interesting to contrast what happened with the euro with what happened with the quasi-dollar bloc of the US and China, right? We had a lot of capital flow frictions with the US and China, but because it wasn't hard-pegged and they were able to come up with a basket and a weave, there was more of a pressure release mechanism there than you necessarily saw within the euro. So that might be a nice contrast for somebody to eventually study.
So I am afraid that even with our late start, we're out of time. We'll shorten up the break and try to start at 11. Thank you all very much, and please join me in thanking the panel.